Silver is moving because stress inside the financial system has crossed a measurable threshold, not because of inflation, not because of gold, and not because of interest rate expectations. And most investors are still reading the wrong dashboard. In the last several sessions, silver has advanced roughly 4.5%, while the US dollar index was essentially flat, and US equities remained strong. Over that same window, the 10-year real yield compressed by about 0.1 percentage points, close to a 9 to 10% drop relative to where it started. Those two facts together are the hook. Silver is rising even though the usual suppressors, a firm dollar and risk on equities, did not meaningfully loosen. That is your first clue that the driver is structural, not a headline you can screenshot. And here is the uncomfortable part. Most investors are watching the Formteutoizu front page indicators, CPI headlines, Fed soundbites, gold ticks, while the relevant signal is forming in the background. Real return expectations, physical availability, costs, and balance sheet positioning. That is why people get caught flat-footed. They don't miss the move because they are stupid. They miss it because they are looking where the TV points. If you are still waiting for one clean headline, the CPI print, the Fed speech, the gold is up so silver follows column story, you are letting the public narrative choose your timing. Markets move first. Explanations arrive later. That gap is where portfolios get repriced without permission. Here is what actually happened in sequence, with numbers. Nominal rates stayed high, keeping the public narrative locked on tight conditions. The US 10-year nominal yield held near the upper end of its recent range, yet the real yield moved the other way. A decline from just above 2.0% toward the 1.9% area looks small until you translate it into incentives. Real return expectations shrank materially, even as the nominal story stayed hawkish. That is pressure inside the system, not relief. Gold reacted first, rising around 0.6%. That was enough for commentators to recycle the standard explanations. Inflation hedge, geopolitical bid, central bank accumulation. Silver barely moved at the start, hovering near 0.2% with volume running roughly 15-20% below its short-term average. To most observers, that confirmed the old template. Silver follows later, silver needs gold, silver needs a weaker dollar. That template broke, not on the chart at first, but in the plumbing. Physical premiums widened quietly. In key distribution hubs, the premium moved from the low 4% range to above 6% within days, a jump of roughly 2 percentage points, or about 50% relative to the starting premium level. That is not retail hype. That is the cost of immediate availability rising. At the same time, COMEX open interest contracted by roughly 3 to 4% while price held firm. When exposure shrinks while price refuses to fall, it is not lack of interest. It is risk being removed. And you can see that risk removal and what did not happen. There was no explosive upside gap, no viral frenzy, no single reason everyone could point to. Silver simply started to bid higher in an environment where it shouldn't. It printed higher lows across consecutive sessions and held gains into closes instead of giving them back. The behavior you get when supply is being absorbed rather than when traders are flipping headlines. Then the detachment became undeniable in the US session. Risk assets were strong. The S&P 500 added about 0.8%, and the Nasdaq gained over 1%. The dollar index was effectively unchanged. Under normal correlation sets, that environment pressures precious metals, especially silver. Instead, silver rose close to 2% intraday, with trading volume more than 25% above its 30-day average. Gold, by contrast, added only about 0.4% in the same session. Silver outperformed gold by more than 2 to 1 in a setup that historically pushes silver lower, not higher. Another tell, the gold to silver ratio tightened not because gold collapsed, but because silver started doing more work. Even a small compression of a few points in that ratio over a short window is meaningful, because it requires silver to outperform while the market still treats it as a secondary metal. Positioning data reinforced the point. Commercial hedgers reduced short exposure by more than 6%, while managed money long positions increased only around 1%. This was not a speculative stampede. There was no broad-based leverage pile-in. The adjustment came from participants who manage inventory, delivery risk, and balance sheet exposure, the people closest to real constraints. By week's end, silver was up roughly 4.8%. Gold was up a little over 2%. Copper was up under 1%. Silver did not simply rise, it separated from both precious and industrial peers. And the why cannot be answered by the 3 lazy explanations investors keep repeating. If this were inflation-driven, gold would have led decisively, and inflation break-evens would have surged first. If this were rate-cut-driven, the dollar would have softened and duration would have rallied cleanly. If this were speculation-driven, open interest would have expanded sharply, not contracted. None of those conditions were present at the same time. What was present was a tightening of real return expectations, rising physical friction, and a reduction in paper exposure. The exact recipe for a market that is beginning to price internal strain. So the correct question is not, why is silver up? The correct question is, why did the system choose silver as the messenger before the story arrived? Because the signal everyone is watching, the headline, is always downstream. The signal that matters is the one in the structure. So when I say wrong signal, I mean this. Investors are waiting for price-based confirmation from gold or a macro headline that gives them permission to act. The correct signal is earlier and less comfortable. Real yields compressing while nominal yields stay high, physical premiums widening before futures break out, and open interest falling while price rises. That combination says the market is paying for access and reducing paper risk at the same time. In the next section, we'll pin down the mechanism behind this repricing, where the stress is building, why it surfaces through silver, and why the move accelerates when the crowd finally notices. The reason this repricing surfaced through silver, and not first through equities, gold, or credit, comes down to how stress migrates inside the system before it becomes visible. Markets do not reprice in a straight line. They probe for weakness where liquidity, leverage, and necessity intersect. Silver sits exactly at that intersection. Unlike gold, silver is not held primarily for balance sheet decoration. A significant portion of annual demand is non-discretionary. It is embedded in manufacturing chains that cannot easily substitute away from it without cost. At the same time, unlike base metals, silver trades through a deeply financialized paper market that allows large nominal exposure to exist with relatively thin physical backing. That combination creates sensitivity. When internal strain builds, silver feels it earlier. The first driver behind this move was the compression of real return expectations without a corresponding easing of nominal conditions. That is an unstable configuration. When real yields fall by close to 10% in relative terms while nominal yields remain high, the message to capital is contradictory. On paper, policy still looks restrictive. In practice, the reward for holding duration-adjusted cash deteriorates. That gap forces capital to seek protection without waiting for official confirmation. This is where silver comes in. It is small enough, liquid enough, and structurally constrained enough to respond before the consensus adjusts. Gold often moves when fear is explicit. Silver moves when tension is implicit. The second driver was physical market friction. A widening of physical premiums from roughly 4% to above 6% does not sound dramatic until you understand what it represents. That change is not about speculation. It is the price of immediacy. It means participants are paying more to secure metal now rather than later. In percentage terms, that premium expansion represented roughly a 50% increase in the cost of immediate delivery relative to baseline. Futures prices do not need to spike for that signal to matter. By the time futures respond, the physical constraint has already been priced by those closest to it. At the same time, the paper side of the market was moving in the opposite direction. Open interest declined by roughly 3 to 4%, even as prices firmed. This matters because it tells you who is acting. When open interest rises with price, leverage is entering. When open interest falls while price rises, leverage is leaving. Risk is being taken off the table, not piled on. That behavior aligns with institutional balance sheet management, not speculative enthusiasm. The third driver was correlation failure. Silver advanced nearly 5% over the week, while the dollar was flat and equities were strong. Historically, that combination suppresses silver. The fact that it didn't tells you that the usual suppression mechanism was overwhelmed by something else. Correlations break not because history is wrong, but because conditions have changed. When silver rises in spite of its headwinds, it is responding to a force stronger than the model. Put simply, silver was not chasing a story. It was reacting to stress that had already formed. This brings us to the short-term outlook, not in narrative terms, but in probability terms. Over the next 1 to 4 weeks, the critical variable is not whether silver is overbought on a chart. It is whether the internal drivers that pushed it higher continue to operate. If real yields remain compressed, even if nominal yields stay elevated, the pressure does not release. If physical premiums remain elevated above recent norms, supply friction persists. If open interest fails to rebuild aggressively, it means participants are still reluctant to re-extend paper exposure. Under those conditions, silver does not need a new headline to move higher. It simply needs time. Consolidation above recent breakout levels would be constructive, not bearish. Shallow pullbacks on declining volume would signal absorption, not distribution. In that scenario, incremental gains of another 3 to 6% over a multi-week window would be consistent with how silver behaves when it reprices risk quietly rather than explosively. The risk to that short-term outlook is not a sudden collapse in demand. It is narrative interference. A sharp, headline-driven spike in yields that reverses the real yield compression could temporarily stall the move. A disorderly dollar surge could also slow momentum. But note the asymmetry. Those factors can pause the move, not erase the structural shift that has already occurred. This is why timing matters differently here. Investors waiting for confirmation, a dovish pivot, a CPI shock, a gold breakout, are anchoring to lagging signals. By the time those arrive, positioning will already have adjusted. The repricing that matters will have taken place quietly, while attention was elsewhere. The deeper risk, however, sits beyond the next few weeks. Silver's move is not isolated from the broader macro backdrop. It is entangled with it. Elevated sovereign debt levels, persistent fiscal deficits, and rising geopolitical friction all feed into the same constraint. The system's ability to absorb stress without repricing real assets. When that ability weakens, markets look for instruments that can transmit the signal quickly. Silver has historically played that role, not because it is special, but because it is exposed. This is where investors often misjudge the situation. They look at silver and ask whether it is cheap or expensive. That is the wrong frame. The correct question is whether the system is comfortable. Right now, the system is adjusting. In the next section, we will examine the medium-term risks that sit behind this adjustment, geopolitical pressure points, fiscal dynamics, and the conditions under which a quiet repricing turns into a visible one. The medium-term risk picture becomes clear once you stop looking for a single trigger and start measuring persistence. Markets rarely break because of one event. They reprice because pressure remains unresolved long enough to force behavior to change. That is the stage silver is reacting to now. Start with fiscal pressure. Over the past 12 months, U.S. Treasury issuance has increased by more than 20% year over year, even as economic growth expectations cooled. Deficits are no longer cyclical, they are structural. Federal interest expense alone has risen by over 30% compared to the prior year, consuming a growing share of fiscal capacity. This matters because it locks nominal yields at elevated levels regardless of short-term economic softness. When nominal yields stay high, but real yields compress, as they already have by nearly 10% in relative terms, the system enters a contradiction. Capital is told conditions are tight, yet real compensation for holding cash-adjusted assets deteriorates. That gap does not resolve politely. It forces reallocation. Silver reacts early to that contradiction because it sits downstream of it. The geopolitical layer compounds the issue. Global trade is not collapsing, but it is fragmenting. According to recent shipping and logistics data, average delivery times for industrial inputs remain roughly 12 to 15% longer than pre-fragmentation norms. That may sound manageable, but in materials with low substitution elasticity, it translates into precautionary behavior. Buyers pay more to ensure availability. That is exactly what rising physical premiums signal. A premium move from 4% to above 6% is not just a 2-point change. It is a 50% increase in the cost of immediacy. When that persists for weeks rather than days, it tells you participants are adjusting behavior, not speculating on price. Now add the financial structure layer. In the silver market, paper claims routinely represent multiples of annual physical turnover. That system functions smoothly only if participants are willing to roll exposure continuously. When confidence in that rollover weakens, even slightly, elasticity disappears. We already saw the early phase of that process. Open interest declined by roughly 3 to 4%, while price rose nearly 5%. That divergence matters. Historically, during speculative advances, open interest expands by double digits as leverage enters. That did not happen here. Instead, exposure contracted. That means risk was being removed, not added. This is where complacency becomes expensive. When fewer participants are willing to carry paper exposure, each incremental unit of physical demand has a larger price impact. You do not need demand to surge 20% for price to move. A 3 to 5% shift in willingness to supply paper can do the work instead. That is why silver can reprice without drama and without warning. Look at volatility behavior. Despite a near 5% weekly price gain, implied volatility in silver options rose by less than 2 percentage points. That tells you fear is not yet present. The market is not hedging aggressively, it is adjusting quietly. Historically, that phase precedes the sharpest repricing, not the weakest. Correlation metrics reinforce the message. Over the last several sessions, silver's correlation to the S&P 500 dropped materially, even as equities rose by more than 1% on multiple days. Its inverse correlation to the dollar weakened as well, despite a flat DXY. When an asset stops responding to its usual suppressors, it is no longer trading the story, it is trading the condition. The medium-term risk, therefore, is not a sudden reversal. It is persistence. If real yields remain compressed within the 1.8 to 2.0% range, while nominal yields stay elevated, pressure remains. If physical premiums stay above the 6% level instead of reverting toward 4%, friction remains. If open interest fails to rebuild meaningfully, say remaining 5 to 10% below prior highs, elasticity remains impaired. Under those conditions, silver does not need excitement to advance. It only needs time. This is where investors get uncomfortable. There is no clear buy signal flashing on mainstream dashboards. There is no dramatic headline justifying urgency. Yet the cost of waiting increases subtly each week. Entry points feel worse, not because price explodes, but because pullbacks become shallower and shorter. Historically, this is the phase when silver moves 10 to 15% over a few months without attracting broad attention. By the time the move is obvious, the easy positioning window is gone. The real danger is misinterpretation. Investors assume that because volatility is contained and sentiment is calm, risk is low. In reality, low volatility advances driven by structural tightening are the most destabilizing later on, because they leave the market underhedged. Silver is not screaming. It is refusing to relax, and that behavior is far more informative than any headline. In the final section, we will bring this together into a clear conclusion: what silver is signaling, what it is not signaling, and how investors should think about positioning when markets adjust before permission is granted. At this point, the picture should be clear, not because of one chart or one data point, but because of how multiple signals are lining up at the same time. Silver is not reacting to a story. It is reacting to conditions that have already changed beneath the surface. Let's summarize what the market has already priced in, using facts, not interpretation. Silver advanced roughly 4 to 5% over a short window, while U.S. equities gained 1 to 2%. The dollar index remained effectively flat. Nominal yields stayed elevated. Real yields compressed by close to 10% in relative terms. That combination is rare. Historically, when equities are strong and the dollar is not weakening, silver underperforms. When it doesn't bot, when it rises anyway, it is responding to a force stronger than correlation. At the same time, physical silver premiums expanded from programmed 4% to above 6%, a 50% increase in the cost of immediate availability. COMEX open interest declined by roughly 3 to around 4%. Commercial short exposure dropped by more than 6%. Managed money long exposure rose by only about 1%. Those numbers describe a very specific behavior pattern. This was not speculative enthusiasm. This was not retail fear. This was balance sheet risk being reduced while physical friction increased. That is a structural repricing, not a trade. Now look at what did not happen. Inflation break-evens did not surge by double digits. The dollar did not fall 3 to 4% in a week. Open interest did not expand 10 to 15%, which is typical in momentum-driven silver rallies. Implied volatility did not spike aggressively. It rose only marginally by a couple of percentage points at most. In other words, the market moved without panic, without leverage, and without permission. That is the most important takeaway. When markets reprice loudly, everyone sees it. When they reprice quietly, most people explain it away, until the cost of ignoring it becomes obvious. Silver has historically punished that complacency, not because it is special, but because it is sensitive to exactly the kind of stress that builds when systems are stretched but not yet broken. So what is silver actually signaling? It is not signaling runaway inflation tomorrow. It is not signaling an imminent rate cut. It is not signaling a collapse in equities next week. It is signaling that the system's tolerance for internal strain is being tested. High deficits combined with high issuance keep nominal yields elevated. Rising interest expense, up more than 30% year over year, limits fiscal flexibility. Fragmented supply chains extend delivery times by 10 to 15% versus pre-fragmentation norms. Physical markets respond first, because they have to. Paper markets respond later, because they can delay. Silver sits between those two worlds. That is why it often moves before the explanation feels satisfying. By the time the narrative becomes clean, by the time analysts agree on the reason, the adjustment is already well underway. Historically, that is when silver has already moved another 10-20% beyond the levels where people felt comfortable paying attention. This is where psychology matters. Most investors do not miss moves because they lack information. They miss them because they wait for comfort. They want a headline, a consensus, a confirmation signal that reduces regret. Markets do not reward that behavior. They price it. Right now, the market is telling you that the old dashboard is lagging. Watching CPI prints, Fed speeches, or gold ticks for permission means reacting to effects, not causes. The cause is already visible if you are willing to look at real yields, physical premiums, and positioning at the same time. Silver is not forcing urgency. It is removing complacency. That distinction matters. If current conditions persist, real yields constrained, physical costs elevated, paper elasticity reduced, silver does not need excitement to continue repricing. It only needs the absence of relief. Sideways action at higher levels would not be weakness. It would be confirmation that the adjustment is being absorbed, not rejected. And if those conditions intensify, even modestly, the move does not stay quiet. The final point is this. Markets rarely give clear entry signals during structural shifts. They give warnings, subtle ones. Silver is acting as one of those warnings now, not because it predicts catastrophe, but because it reflects stress honestly. Ignoring that signal does not make it disappear. It just means you notice it later when adjustment is no longer optional. That is what silver is saying. And that is why watching the wrong signal is the real risk.